Good evening, everybody. Thanks so much for coming out. I know we've got people, so it's nice to be here in person. Thank you. But obviously, we've got, just given the uniqueness of 2020 and everything going on, we've got really probably half the group watching virtually. So we want to be respectful of everybody's time and get everything started. So anyway, again, thank you to everybody that's come out. It's great to see everybody, great to see familiar faces. Obviously, we have not gotten together as a group. I think we had a golf outing in June, but otherwise it's probably going back to February. I don't recall if we had a March meeting, but I don't think we probably did, as the financial markets were in ruin the third week of March, which is when our typical meeting is. So it's great to be out here. I think, a lot has changed, but a lot hasn't changed since then. So anyway, I think this should be a great panel. So we're here tonight to discuss the state of the Tampa Bay real estate market. We've got 4 great panelists. 3 of them are currently on the board of REIC, and 1 is on the advisory board. And so they're very kind to just give us their time and perspective. Before I jump into that, I'll get back to them. I do want to cover some business for REIC. Tomorrow night, November 19th, we do have a Young Professionals event. It's a Friendsgiving at Hall and Franklin. So hopefully those of you that are comfortable going out and interacting and are starving for that social interaction, all socially distanced, of course, please go out. Should be a nice event. And then same thing on Wednesday, December 16th. We are going to do a holiday party at the Tampa Bay History Center. They've got a nice outdoor space as well as a big kind of pavilion on the second level. It'll be catered by Columbia. Should be a nice event. It's new for REIC. We typically have not done anything in December just due to everybody having so much going on. But with 2020 being unique as it is, we thought it'd be a good idea to try and put something together. So hopefully we'll see a lot of faces out there. Jumping into our panel, they're finishing dinner, but I think they're kind of wrapping up. We're lucky enough to have Vince Chalura. He's the senior VP with Valley Bank. And I'm not going to go into their individual bios. I'll let them kind of discuss who they are, their role in the bank or in their firm, and just kind of give a general overview. We've got Dan Woodward, who's the division vice president of Tampa with Highwoods Properties. Mike DeBlasi, who's the managing director of CBRE, and Nancy Surak, who's the managing broker with Land Advisors. So let's give a big thank you and round of applause to them, and hopefully they can come up and join us. All right. So I gave kind of your name, position, and company. If each one of you can kind of go into further detail, just give us a general overview of obviously who you are, what you can cover where you work and what you do, and just kind of give us a general overview of, cover the basics. So we'll start with you, Dan.
All right. I'm Dan Woodward with Highwoods Properties. I'm the division vice president for Tampa and the market lead for Tampa. And just happy to be here at least my first in-person event. So thank you.
Hi, I'm Nancy Surak. I am the Senior Land Advisor and Managing Broker for Land Advisors here in Tampa Bay, Florida. Land Advisors is a national land advisory and brokerage firm. We have 26 offices throughout the United States. We're headquartered in Phoenix, Arizona, but we cover California, Arizona, Utah, Texas, Florida, North Carolina, Georgia, and Idaho. And I'm sure I'm missing other states, but it's a great organization, and I'm happy to run the office here in Tampa.
Hey, good evening. Vince Chalura with Valley National Bank. I run the commercial real estate lending team for the institution. We focus on the state of Florida and Alabama. We've been actively involved in many projects, both large and small, in this market and in other markets that we serve. Valley's a $42 billion bank, publicly traded middle market lender, kind of focused on our bread and butter is commercial real estate and C&I lending. I was part of the team that helped grow US AmeriBank, what was US AmeriBank, from a startup de novo to about a $4.5 billion institution before we were acquired by Valley 3 years ago. So happy to be a member of the community, and happy to be a part of the Valley team now. Bigger balance sheet, some exciting things. So it's been a challenging few months, but I think there's some exciting things to come, specifically in our market. So happy to be here and provide some perspective.
And I'm Mike DeBlasi. I'm the managing director for CBRE here in Tampa. We are officially the world's largest commercial real estate services provider. Anthony will probably tell you, most days I wonder what I actually do on a daily basis. I don't produce anything. Most of the time I'm making sure everybody else is doing what they're supposed to be doing, but happy to be on the panel and possibly provide some insight into some things we've got going on here in this market.
All right. Thank you, everybody. That was a very modest introduction, so I'll fill in some. But so Dan runs Highwoods Tampa office. Highwoods is one of the largest office REITs in the United States. They are the largest landlord in Tampa Bay. So he oversees a very large team and a very large portfolio of some of the highest quality assets in the entire Bay region. Nancy obviously is part of a national network of brokers covering land deals of all sizes and across industry types. Vince, as he mentioned, is probably one of the most active lenders. I know I personally, across my business ventures, bank a lot with Valley. I know a lot of people that do. They're probably one of the most entrepreneurial groups. Obviously, they built the bank here in Tampa, sold it to Valley. Now they've got a larger balance sheet, so they can really do some interesting things. And he works with a lot of people in this room. And Mike, although he questions what he does on a daily basis, like he said, he manages the Tampa office for the world's largest real estate services firm. He's got a huge team of brokers that work underneath him across all aspects, from capital markets, leasing, investment sales, as well as a huge property management and services division, including appraisal and other areas that I'm not touching on. So again, they're being modest. Hopefully we'll open the discussion up and they'll kind of give us their insights here. But so it's a great panel we've got. I think hopefully we'll have a lively discussion. So again, thank you. I guess with that, we'll start. Vince, you're the lender on the group. 2020 has been a really, I think, just interesting time. I think most people would say the economy was going gangbusters. What has changed since the onset of COVID? And has your perspective as a lender changed on Tampa Bay? And is it, and maybe getting more specific and granular, is it changed by property type?
Yeah, great question. Obviously things were hot. They've been hot for a long time, and then COVID hit. There was a lot of distress I think the obvious asset classes that were crushed were hospitality. It's remained very challenging, and some select retail, but I think there are still some pretty decent asset classes. I mean, industrial's hot as can be. There's some select office that's doing well. Retail on the net lease side and grocery anchored centers, we see a ton of requests in that space. But the obvious food groups that are getting a lot of attention are hospitality and some special purpose type assets. We think that they will recover. It's just how long will it take? We, as an institution, we're a huge administrator of the PPP program, and we're active in processing payment deferrals and loan modifications, and we've been real proactive in that space, just trying to be practical and really helping folks that had a hardship and that had a need. So in general, there's a ton of loan activity. We as a bank have been servicing our core clients, people that we know and trust, that have deep pockets and are doing the right types of projects and approaching things the right ways. But hospitality lending and some certain select retail, kind of COVID related retail has really been hurt.
And I guess just kind of continuing, how have your underwriting standards changed from, let's say, end of last year or pre-COVID to now? Are LTVs lower? Is it much more borrower centric, business plan specific? Is it just hotels are off, not even an option because of, just general exposure? What's the general outlook?
Yeah, we try to remain pretty practical in the way we approach things and the way we think about risk. Big picture, we're going to be very conscious about sponsor support, experience, and expertise. We've always been traditionally a recourse lender, and that remains. That's really important in this environment. Typically on high leverage deals, we may ask for a little bit more equity. We may ask for some tighter underwriting standards, some more covenant driven type solutions. But in general, if the deal is a solid deal, we're focused on credit quality and predictability of the income stream. So if that remains, we're going to get a deal done. I mean, again, I mentioned earlier, we're focused on servicing our core clients and doing business with those we know and trust, and also bringing in some new names in the process. I mean, during the middle of COVID, we had a few opportunities to look at grocery anchored shopping centers, public specific, and some opportunities that lenders, just for whatever reason, they were sticking their head in the sand and didn't want to look at what traditionally has been a very simple underwrite, and we were able to gain some additional market share and get some good customers in the bank throughout that process. So again, just kind of remaining practical and trying to analyze risk and really look at solid deals for solid folks.
And obviously a big part of that you said was cash flows. So what's the bank's outlook on ground up construction loans in general?
Yeah, in general, we've always looked at construction as what's spoken for. If something's pre-leased or substantially pre-leased, or there's predictability of an exit, we're going to look at it. I mean, talking about a net lease development or a grocery anchor type development, we do those all day long. So we'll welcome anybody that wants to borrow money on a Publix anchored shopping center. So development lending, obviously, we're still looking at it. There's some asset classes that are hot. You talk about self-storage, you talk about hospitality, you talk about multifamily. There's a ton of that supply in various markets. And again, we're looking at some of those deals, but if you talk about land development opportunities and multifamily development, we're being pretty conservative.
Right. All right. Thanks, Vince. I guess on that, and just trying to transition from construction, the biggest component of construction is getting control of the land. So Nancy, just what is your viewpoint on land in Tampa Bay, and maybe break it down by sector and just general activity you're seeing?
Okay, so in Tampa Bay, I cover all land types. The residential land market is really on fire. Single family homes are selling at the fastest pace that they've sold in quite some time. Multifamily is also performing incredibly well. And that just translates into additional demand. In the month of September, home builders reported that they wrote 55% more contracts this September than they did last September, which is a huge number. But it didn't just end there. Multifamily groups reported that in the third quarter of this year, they actually leased 22% more units. So when you translate that into the migratory patterns that we're seeing out of the Northeast, folks are moving here. It's not just about folks who are currently living here. We're having a huge population growth occurring throughout our region, and that just means more demand for land.
And is that, just to clarify, is that at a national level or is that specific to Tampa?
That is specific to Tampa.
Okay. All right.
We are actually really outperforming the nation on both of those sectors. There have been several reports that have ranked Tampa the #1 market for people that have moved since COVID. Since March, they're coming here in droves, which is great for our economy, but it's going to put a strain. It is putting a strain on supply. So there's a lot of home builders that are looking for property elsewhere, not just in Hillsborough County, but all of our market sectors, and moving into now secondary and in some cases tertiary markets, because that's where they can build a more affordable product. Moving away from the residential side, which is on fire, I have lots of activity in the industrial land, and that doesn't seem to be slowing down anytime soon. Some of the bigger users like Amazon, they are now positioning, I'm seeing them position on smaller footprints, trying to get into more urban settings or closer to the urban core to satisfy the demand that we've seen from the online shopping shift this year. I don't think that that's going to necessarily slow down either. I think they're just pivoting to be more creative. Self-storage is been pretty standard. I'm seeing a little bit of activity there. But for the most part, the three most popular segments are single family, multifamily, and industrial land right now.
And are you seeing any, stress from landowners? Is there any sectors that are, in general, people don't want to touch them, or any stress, or is it just, hey, we're a believer in the Florida growth story in Tampa, and people are long land in Tampa?
So no offense to Dan, but I'm not hearing from any office developers right now.
Okay.
Not at all. I will say that one interesting thing I am seeing is a significant amount of increase in calls for me coming out of Chicago and New York for folks who claim to be running with some REIT partners and some pretty interesting use that is not in our market. So I'm piqued. My curiosity is piqued with that. And I'm also seeing a lot of interest for a new product that is considered, or it's been described to me as a car cave or a man cave, where folks can go and put their collector items, men and women. So that's an interesting component. I think that sort of falls under storage, but that's gaining some traction, which I find very, very interesting. I don't know if it's because folks are living at home right now and they're like, hey, you got to go take your toys somewhere else. But I am seeing that and hearing that. There is some caution with land in terms of just not having an asset bubble. So the deals still have to underwrite, and I can't really stress that enough, but there is significant demand in my world.
And I guess on that topic, knowing that deals have to underwrite and development's very capital intensive, have you seen a tightening on deals that you're working on from construction lenders? Obviously, it sounded like Vince's group has been very active, but I think they're one bank in a very large group of banks. Are you seeing a tightening? Is any lending requirements or anything else put a hamper on it, or is demand outpaced?
On the residential side, demand is pretty strong. When the single family builders can report that they have 1 month of brand new supply on the market, that's really tight. Multifamily is still very strong, but I would say that I have seen some tightening there of the underwriting. In particular, I'm aware of at least one or two deals that have gone through syndicated lending, which I've never really heard of until recently, where you've got, I mean, you've always had a different people making up different parts of the capital deck, but where there's traditionally been maybe one bank, I'm seeing three, which is pretty unique. They're spreading the risk, but they're still doing the deals, and deals are still happening. But I think data is driving a lot of the decisions. And when you see the population growth, they're trying to weigh that. But yeah, definitely some tightening, but not any that is too alarming. I think it's healthy.
Great. Thank you, Nancy. Mike, jumping over to you. So what's the general outlook in your office? Obviously, I think you get feedback and see the numbers from all your different divisions, from capital markets to investment sales across sectors to leasing. What's doing well? What isn't? What do people have questions on? As a manager, how do you feel about the outlook in Tampa Bay?
Sure. So we're fortunate in the fact that I kind of view our office as a kind of like a stock portfolio. We have some winners and some losers. They're all winners in my book, right? Right, Watson. But we may be the only office in the country for CBRE where we've had revenue growth from over 2019. So we're up about 10% year over year. I'd like to think that's because we got really awesome people who haven't given into the excuses that many people make in times like these. So, I mean, from a perspective of where's the growth from 2019 to 2020, our multifamily team has really crushed it this year. We've closed 35 deals, 27 of which have been in the COVID era, for about a transaction volume of close to about $580 million for the year. And we have about $300 million in current listings out on the market. So clearly multifamily is still moving. From the industrial perspective, I mean, 2020 is going to be the banner year for industrial, I guess, until we get to 2021, which may eclipse it. We just can't keep up with all of the deals that are coming through. And from a person that 10 years ago was a struggling industrial broker, it's kind of nice to see industrial rise to the fame that it has today. I've got office brokers that now want to be industrial brokers. So that's when you know times are good in the industrial world. Certainly retail's taken a big hit. We just brought over a pretty dynamic team that runs with a lot of retailers, and they're active, still in the grocery business. The quick service restaurant business is still active, and other retailers as well. And then on the office side, it's a bit of a mixed bag, right? So we work with a lot of landlords, we work with a lot of tenants. I think it's kind of tough for everybody to figure out what their footprint really looks like long term. The opportunistic tenants we've had see this as a time, if they can commit to something, they might get a good deal. They might even get their name on a building. So those are kind of the things we're seeing across our office. But we clearly think long term, especially into next year, as the vaccine comes out at some point and people start getting back to work, because I mandate they come back to work, that we will continue to see Tampa Bay thrive. I mean, I think all the metrics that we track as far as how well Tampa Bay is doing will just continue to improve. I mean, we've got people that want to, as the experts here pointed out, want to live here, want to work here. And especially when we have days like today, it's only going to help our cause. So we feel we're very bullish on the entire Bay Area and certainly on all the food groups as well.
Great. Thank you. And I guess to just build on that. So what is the general, when your brokers are out talking to investors that are, they're managing investment portfolios where they can put their capital anywhere, probably globally, maybe nationally, what's the general feedback they're getting on Tampa? Do people want to put their money in Tampa right now? Obviously, it sounds like in the multifamily, absolutely. Do you see that slowing down, or your guys and our investors' perspective, is it positive on Tampa Bay?
Yeah, I just think from a general investment perspective, a lot of investors are looking to move their money into the Sun Belt and the Southwest markets. I think this whole people don't want to be stuck up north is going to have an effect. I can only imagine being in New York City right now, thinking I'm going to live through the winter where I'm going to have to stay in my house while we're out frolicking at a REIC event. I think that only helps our cause, which we were seeing that before. Clearly, I think there's been a move to want to invest in industrial for obvious reasons, just given the uncertainty. Certainly, most of the industrial is owned by institutional groups, so it's kind of tough to crack into that food group unless maybe you're getting a piece of land and developing a building. And then I think the long-term prognosis for our office market is still very strong, and we'll continue to see those effects in many years to come.
Great, thank you. All right, well, with that, let's jump over to Dan. So Dan, you're the largest landlord in Tampa Bay. You have probably some of the best quality assets in Tampa. You have assets across really West Shore and downtown and maybe some other markets, but those are your primary markets, which are the two largest and institutional markets. You've got a building under construction in Midtown. Just what's your take on Tampa Bay, the office market, your portfolio? How are things doing?
Sure. Yeah. Thanks, Greg. From an office perspective, it's interesting hearing from all the other panelists. Clearly we're not the golden child of industrial or life sciences, but we're also not retail or hospitality. So office is a little bit of monkey in the middle right now. From March, when COVID really hit and most of the nation went to work from home, the Highwoods portfolio has been open. We've been open and operating. Our buildings have been functional largely for any companies that either wanted to have a workforce in place or was designated an essential business. So, we've been functioning fairly, I wouldn't use the term normal, but we've been functioning as normal as possible during that period. Having said that, obviously our occupancy hasn't been up to the levels that it has been in the past. So right now we're probably looking at about 25% occupancy overall in the portfolio. Having said that,
just to clarify, that's physical occupancy.
That's physical occupancy.
Yeah.
Having said that, our collections have been in the high 90s. So, most of our customer base has been high credit customer base. They've been able to pay even though their folks aren't in the office and utilizing it, but they have access to it. So, our outlook for Tampa is extremely good for all the reasons that we hear up here today. Not the least of which is basically before we went into this pandemic, the Tampa Bay market commercial real estate fundamentals across the board were some of the strongest I think any of us have ever seen. And this was not an economic induced downturn. This was a health induced downturn. So going into this downturn, I think we'll come out of it beat up. Obviously we will. We won't come out of it immediately where we were before, but we're going to come out very stronger. We're in the Sun Belt, for a lot of the same reasons, given our cost competitiveness, given our ability to be outdoors, socially distanced, things like that. There are a lot of companies right now that are looking at their existing portfolios in the Northeast, California, some of the other high cost states, and they're looking at the Sun Belt, particularly Tampa. And one of the big reasons they're looking at Tampa is because our skilled talent here. The EDC, the Tampa Bay EDC is getting a lot of inbound traffic, and they're not even out there beating the bushes on the airplanes. They're getting a lot of inbound traffic and interest in the Tampa Bay area. So, I think Highwoods is particularly strong on the Tampa Bay area, as well as all of our other markets in the Sun Belt as well. So.
Great, thank you. And I guess just what are you guys, and this is probably more specific to the office sector in general, but I think if you ask Mike, he'd probably tell you that, or he mentioned it, people are really trying to figure out what they're going to do with their office. I think it's just a big question. And I saw, I think it was an interview with Barry Sternlick, and to your point, you touched on it. He said, he did it based on traffic lights. He said hospitality, red light, retail, red light, office, yellow, industrial and multi, green, right?
Right.
And there's just, I think, a lot of questions. So you look at kind of companies, I know we have a much smaller portfolio, but we're similar metrics, 98% collected. So from a cash flow standpoint, it's held up pretty well. You have long-term leases, but there's a huge question as to future demand for office and how people utilize it. Is the stay-at-home work, is it here to stay? What's your consensus? What are you seeing? What's the feedback? I mean, I've read stuff that some tenants are taking more space because they need more space to spread out. Some just, they're saying productivity isn't as good working from home. They're seeing huge drop-offs, in particular on Mondays and Fridays. And so, just what's the general, I don't think nobody has a crystal ball, but
No.
what's your general outlook on it?
Yeah, nobody does have a crystal ball on this. We can't see over the horizon right now. That's pretty tough to do. It's interesting. There were a lot of productivity studies done in March and April when they sent everybody home.
Yeah,
There was work from-
they're scared to get fired.
Right.
Yeah.
Well, there's number one. And number two, everybody was on so much lockdown. There wasn't a whole lot of other things to do other than work. So obviously we're going to see the productivity pretty high. I think most everybody's studies you've seen lately over the past couple of months is that productivity has dropped. And it's dropped for a variety of reasons. Number one, you do have some distractions now as things start to open up a little, despite the spike in COVID. You do have some distractions. And I think number two, people are realizing that they don't have the culture at work at home. They have distractions. There's no work culture, and we're social beings. And I mean, look at us here. How many, I think everybody wanted to come to a in-face event. So socially, I think people really want to get back to the office. The question is, I think, what that office is going to look like. And nobody can really answer that until we get through this. It's impossible to tell whether, does this mean now we're going to have fewer people in the office, but those fewer people will have more space? That's entirely probable. But the question is, at that point, then what happens to the new job growth? Does that add to demand? So is the original fewer people but more space per person, is that offset by increased job demand? And as the demographics move towards a workforce that's more office space? So what we've seen in our portfolio is we have not seen a whole lot of our customers that have come back change their space configuration yet. What we have seen, the larger global companies, a lot of them are like, well, we're not requiring our folks to come back until next year. Okay. Some of the smaller local firms, they're already back in. Now, a lot of them are back in, they split their workforce up, and one half of their workforce is in 1 week, one half is in the other week. And that's how they handle the social distancing. But in terms of people making decisions on what their office space is going to look like next year, the year after, we have not seen a whole lot of decisions made on that part. So.
Great, thank you. And I guess just one other thing I wanted to get your perspective on is just the amount of new supply being delivered, kind of frankly mid-pandemic. You've got SPP is delivering here in downtown. You have the Heights Union. You have your Midtown project. You have the airport project. There's probably a couple other projects that I'm not coming to mind, but I think it's well north of 1 million square feet, and it's all Class A, well located, well amenitized space. What's the general activity and what's the feedback that you're seeing? Is it kind of, you feel good about it because of all the growth things we've mentioned, or but it's probably going to take time because people just aren't making decisions where they're committing to 15, 20-year leases during a pandemic, or just what's the general activity in that you guys are experiencing firsthand?
I think it's a little bit of both, Greg. I can only speak to our project at Midtown, and we've seen decent activity. It's probably commensurate with what we're dealing with COVID, and it's probably commensurate with the rest of our existing portfolio. The leasing activity has been a little sporadic. We see fits and starts here and there. a couple of weeks it'll get strong and we'll see a lot of activity, and some of that'll materialize into leases and some of it won't. And then, a couple of weeks after, we'll see it die off a little bit. We have seen a good balance though between, particularly in the new development side, particularly in Midtown tours, we've seen a pretty good balance between existing customers that want to look at new product out there and customers that are new to the Tampa Bay area. I mean, we've seen some promise from that, which reinforces what we all believe about Tampa being a magnet for additional job growth. So we've seen some good points there. Pre-pandemic, I don't think anybody on the office side was particularly concerned about the amount of new construction on the office side they saw. I mean, SPP's got a lot coming out of the ground downtown, but if you added it all up, it was, as you said, a little over 1 million, about 1,000,001. And if you looked at that against our overall market, it wasn't a very large percentage of the overall market for new development. That was pre-COVID. I think based on the uncertainty that has occurred in the market in terms of demand, on top of all the sublease space that has been thrown onto the market, I think that gives people a little more caution. And to Nancy's point, I'm the last one to take offense that nobody's looking at office land for new development. I'm actually happy about that. So,
Yeah. All right. No, thank you. This is great. I think just given the time, I think we've kind of touched on different points of just what everybody's outlook is on Tampa Bay. I think we'll open up for questions. Camille.
So I want our panel to give me their take on Venice and everything. Where are all those people going to come from?
And just to either, I don't know if Jade, I don't know if we have an extra mic. No. All right. Yeah, I'll repeat. So because we've got people watching virtually, and so I'm not sure they can hear. The question from Camille was, what is your take on SPP's project and everything that's coming out of the ground at once? How does that get absorbed? Is that a good summary? Okay.
Where are those people coming from?
Where are they coming from? Probably New York, but.
The Northeast is where they're coming from, and probably some from California as well. But is it enough is the question. I think if you look at the most recent headlines coming out of SPP and Venix organizations, I think that's pretty telling, right? They're having some shift in their leadership and reorganization. That's telling.
That's changing, I think, from construction.
Perhaps, right? Perhaps.
Construction to leasing. I want to know where all those people are going to come from when we have a brand new city 8 blocks away.
Yeah, I think time will tell, right? But I do think that a lot of folks will settle there from the Northeast. But their rentals, I think, might have a little bit higher vacancy rates than what we might see in some other submarkets. They're going to have to be competitive from a rental standpoint. There's just other places people can settle.
Well, I know part of their model is they're building smaller units, probably more in line with what you would see in like a Boston or DC. And so I think it's probably a much higher, it's a more expensive product. I mean, if you look at it, it's just a different level compared to anything else in Tampa Bay. And their rental rates per square foot are going to be higher. But I think the nominal dollars, they'll probably compete relatively well, and they're going to have the nicest product. So I don't know. And then in my opinion, it helps when you've got one of the richest individuals in the world, his fund backing it, and one of the richest individuals in Tampa Bay. I think yeah, but I don't know. I mean, yeah, but if you look at, in my opinion, if you look at what everything we're talking about, and again, we look at it statistically, but there's a lot of net migration here. I think it would be great to see a really big corporation take kind of a really big kind of plant its flag in Tampa Bay, whether it's a regional office or headquarters or something else. But I do think you've got a lot of people that with the flexibility of work from home, Tampa is probably a big beneficiary, and maybe they do rent. Maybe it's transitionary. I don't know. I'd be pretty bullish on it. It's unlike any other product we've seen in Tampa.
I'll quickly comment. I mean, there's a pretty interesting mix of uses. I think the hospitality there ultimately will think multifamily should perform pretty well in that pocket. I think office is the most challenging, but anecdotally, I work for a company that's based in Wayne, New Jersey, and nobody wants to be in Wayne, New Jersey in this environment, or really ever. It's, you want to be 45 minutes to the east in Manhattan, and I don't know if people want to be in Manhattan anymore. So there are companies like ours that are out sniffing around. I think it's a rich price point, but I think it could be reasonably affordable for Mid Atlantic or Northeast group to if we find a headquarters, or if they are able to find somebody that they can get in there and be the lost leader, if you will. I think it's going to go a long way.
Yep, Ame. Here, why don't we do this?
That segues into what you're saying. My question is, for those that have national offices, what are you seeing in Tampa based in other areas of the United States? I travel a lot, and I'm thinking Tampa's kind of in a bubble of COVID, where a lot of other areas are experiencing much more difficulty with the real estate, obviously. So I'm just curious what you're seeing on your company's level.
Yeah.
You guys got that, or do you want?
Yeah, I'll start. I mean, it's relatively easy for Highwoods because the predominant number of our markets are in the Sun Belt and in the Southeast, and they're Nashville and Orlando and Tampa and Richmond and Raleigh, and I think we're all benefiting a little bit from people looking away from the Northeast, away from California, away from the high business, high regulation, high tax states, and they're looking for places where they can do business more cost effectively and where they can get decent labor. And I think what we're seeing across virtually all of our markets is the same type of situation where, you've got a good business climate. You've got leadership in both the state and local levels who understand what drives their economic base. So I think we're fortunate in that point, and what we're seeing across our portfolio is pretty standard all the way. We have a group in Pittsburgh as well that's not necessarily Sun Belt, but right now they're holding their own pretty well. However, having said that, there's some spikes in COVID, and I think you're going to probably see some additional municipalities, go towards kind of, I hate to say lockdown, but throttling back on the economic activity. So we've been very fortunate here with our state leadership and our local leadership, what Mayor Castor's done to keep our development process moving. We have not had any issues at Midtown. We have not had any issues in doing tenant improvement work. So keeping that going and putting the mechanism in to keep that part of our economy moving has helped substantially.
Yeah. Hey, Mike, you're obviously the manager of Tampa. You mentioned you had you're on track for the largest growth of revenue, probably of any office across globally or nationally. I guess in that point, I don't know if they have manager calls where you've got guys that are running offices in other parts of the country. What's the general feedback, or do you keep, I don't know if you talk to them, but like how big of a drop off is it in a market like New York, which obviously is probably the biggest market typically? What is the
from a
difference there?
revenue perspective?
Yeah.
Yeah, I think generally speaking, our revenues across the company are off 20 to 30% for the year. So to be up 9 or 10% or 11%, whatever we are, is pretty substantial. We were the first office in the Southeast to officially reopen just over 2 months ago. And part of that was our metrics on the COVID, containing COVID were fairly strong. And even as of recent as today, I heard of some of the offices across the country being closed back down. There's no indication that would happen here. So clearly it's an indicator that we're not all in the same boat across the country. I mean, clearly there's governments that are taking a little sharper, way with their constituents. Whereas, we're completely in an environment where if you want to come to work every day, you've got that opportunity. Other than putting a mask on when you walk around, it's business as usual. And right now we've got about a 30% utilization in our offices and hoping that once we get through the holiday season that we'll be able to bring that up to the next level. I'm a big believer in people coming back to the office. I just feel like the energy and the brain power that comes together just makes everybody better. So the sooner we can get through all this, the better off I think we'll all be.
Great, thank you.
Awesome. If I could just add, Greg, I was actually on a call with all 26 of our offices today with our CEO and the president of our company, and we are predominantly located in the Sun Belt as well. And I will tell you from a land perspective, our markets are outperforming last year's revenue, the year before. We're busy. And to put it into perspective, the Tampa market here, my office, was the third top ranking by volume in the third quarter, which is pretty substantial because we have such a huge group in Arizona and Texas. And I came in third here in the Tampa market. So that says a lot about what's happening here.
Yeah, also, I mean, I think Arizona and Texas, as you mentioned, are probably reflective of their beneficiaries from California, which
Absolutely.
a little further distance to Florida. Saw some hands back here as well.
Who were the top two?
Arizona, our Phoenix office was number 1, and my Dallas office was number 2.
So just a little bit of background. So I get the idea that, you know, we're benefiting from the exodus from the Northeast and California area to come this way, and the Tampa area and Florida may be benefiting from that. So my next question is more of a national level question. With the huge government debts that are coming in, is there the risk of higher interest rates and inflation in the next 3 to 5 years that could stymie the growth that we're seeing because of low interest rates?
Did you guys pick up? I'll repeat it for people that are watching online. Given the massive amounts of debt our government is taking on to finance PPP, our deficit, everything else, does that pose a risk in the next 3 to 5 years of higher interest rates? I don't know which one of you is the economist, but if you would like to take a stab at it, I'll open the floor.
I went to Florida State, had a sub 3.0 GPA. So whatever I would tell you, you would just throw away. So I'll turn that over to somebody else.
Yeah, this will be a
that's
discussion
fish
for
kind question.
on a different topic. We usually do have an economist come to REIC. We have tried. It has been very difficult to try and coordinate. It's been Sam Chandon, Hank Fishkind, a variety of others. So hopefully in 2021, we will have a great economist come in and speak to everybody, hopefully in person and potentially virtually or some sort of combination. Yes, and I think they'd provide it, but I think my 2 cents are right now, I think interest rates are going to be low for a while, but again, I don't have that crystal ball, and they'll be able to speak a lot better as to whether or not interest rates are going to go up.
Paul's got a question.
Paul. Here, I'll pass it over so people online can hear.
So probably a question for Greg and Vince and Dan, I guess. How are you guys viewing sublease space in terms of an underwriting perspective? How's a lender treating it? If you have dark space or tenants that are up for sublease, how do I sell through it? Yes. But yeah, just curious as to how you guys are dealing with that within either a portfolio or from a loan perspective. Seen several buildings out on the market. Some of them have as much sublease space as they do existing vacancy. And the thought process is how does that sublease space compete with your existing vacancy? So I guess from a lender standpoint would be the most impactful, especially in a larger building with multiple tenants. And then obviously from your perspective, if you're going out and buying buildings, Dan as well. Mike, I don't think you could add anything, but if I'm wrong, correct me.
I think actually it'd be interesting to get Mike's take as to his tenant reps strategy as to try and negotiate better deals for his tenants. But Vince, you want to go?
It really hasn't come up a ton for us. We don't of exposure in larger office properties. I think if the underlying tenant is on the hook and they're ultimately subleasing that space out, the bank is indifferent. I think if you start getting into obligations being passed on, and the lender has got to underwrite the credit quality of the sublease, it's a different animal. We've seen it a little bit. We haven't seen it a lot, but I imagine it's going to be a hot topic over the course of the next 6 to 12 months.
We watch it very carefully because it does compete with our overall existing product. So we track the overall amount, we track the buildings, we track each of those subleases, what the potential opportunity is in that sublease. In other words, how much time is left on that sublease. Traditionally, we kind of viewed subleases as a little bit maybe secondary to a direct lease with a landlord. Is a little bit like, buying your clothes at a consignment store or something like that. You were getting a good deal, but you were getting somebody else's space. I think these days we're watching it a lot carefully simply because of the current situation we're in the current market we're facing. I think the sublease space is probably a good opportunity for a lot of the prospects we're looking at, and we do compete with it directly. So we watch it very carefully.
Mike, what about your tenant reps? If they've got a national account, they've got spaces across multiple markets, would it be a strategy to place multiple offices while people are working from home on sublease? Or is that kind of a corporate real estate strategy, potentially, if you can sublease in one market, consolidate into others? Is that going on, or even just to try and provide leverage with a landlord? Or do you see that where maybe there's more sublease or than actually, or maybe their face amount is more because you've got multiple people on it, but maybe they would head back to the office if they don't get a sublease signed?
Sure. I think the concept of consolidation is certainly going to be there as office users go through the process of deciding what their long-term needs are. I think if you have multiple offices in the same market and you've got a lease expiring, you're probably looking at a way to maybe roll those people into another office. We actually just went through that at CBRE. In February, we bought a group called Site Ready that was in West Shore, had about 11,000 square feet. We made the decision to just go ahead and close that office down and roll those people into our existing office, which produces a sublease opportunity. And so it was merely a fact of cost savings and also the ability we actually had room for them in our downtown office, where pre-COVID we would have never been able to fit additional people in there. So I think all of those decisions are probably trying to, cost savings is probably number one right now. So if you're a real estate director and you can find a way to save a few bucks because you got multiple facilities, or you can house people in a certain spot in a certain market, I think you're taking a look at all of that. At the end of the day, we're still fielding a lot of, so just to give you some perspective, any CBRE represented global company, which we work with the majority of Fortune 500 companies, when that requirement for Tampa comes through the door, it comes to me and I figure out who works on it. So clearly for the first 6-7 months of COVID, those inquiries were not coming to me. We started to field more of those. Some of those are existing tenants in the market. Some other of those are new tenants possibly looking to come to the market. So we kind of use that as a great indicator of velocity and demand, knowing that if you're looking today, the deal is not going to happen for several months into the future. But so for that very reason, we feel pretty good about where things are headed.
Great, thanks. Yeah, and then from my perspective, it depends upon how much term is remaining, what you're competing against, what the existing, vacancy. I guess it's always going to be asset, rent roll specific and asset specific. I think it really would drive kind of how we look at it. I know that doesn't answer a lot, but unfortunately that's, every building and every rent roll is different. So, it'd probably depend on just how much conviction I have on the particular asset and location on how I'd look at it. Jen, I think you had a question.
Yeah, so what are we seeing for lease rates? Probably a question for Dan and Mike. Dan, from the landlord perspective, and Mike,
I think in the first few months of the pandemic, I think in exchange for, you're always going to see economic pressure. I mean, basic economics tells you if there's less demand for your product, the price is going to drop. Well, there's a lot more that goes into pricing a deal than just the rental rate. So initially, most of the landlords, including Highwoods, they were keeping their rents fairly firm, and they were looking at other levers to pull on the deal valuation, more tenant improvement dollars, maybe a little more free rent, things like that, possibly a shorter term. So there are a bunch of different levers they can pull. And what we've seen in the numbers so far is the rents have stayed fairly constant. There hasn't been a big drop in either asking rates or strike price rates in the lease deals. As I said, there have been other considerations in the deals that have helped get them done, but the rental rates have stayed fairly constant. What's going to happen next year as this continues, and if the demand continues to drop or doesn't get much better, it will have some pressure on rental rates, in my opinion, but we haven't quite seen it yet.
Yeah, and I would agree with Dan's sentiment. I think from a face rate perspective, we're seeing those hold pretty steady. Some additional concessions. I mean, if you're one of the handful of tenants up for renewal that's willing to go long term, you're probably getting in hindsight, will be a pretty good deal right now. I'd say the majority of our clients right now with pending lease expirations are going to the landlord and saying, let's kick the can a year. And typically in that scenario, you're going to keep your rate at your expiration rate. So, and we've found that most landlords want to work with the tenants for obvious reasons. I think some of our clients have probably been a little brash in just shutting down an office and not thinking through it long term. And so if somebody's lease is coming up as a landlord, I'm thinking you want to try to keep them there as long as you can until we get through the fog of COVID so they can make the best decision, for the long term.
Yeah, and I echo what Dan and Mike said. It just, as a landlord, when we're negotiating something, I'm going to pull every lever possible outside of face rate. That's going to drive value. And I think it probably also helps right now. Banks are really well capitalized. I think there's also been more equity invested into assets. In particular, we're talking about the office sector. I think when I first got into the business, you were seeing 85%, 90% loans with an interest reserve and kind of a mark to market. Lenders in this environment have been underwriting and lending on real cash flows. And so I think you've got more equity and a bigger buffer in there, and probably better capitalized owners to be able to carry it longer. And just in general, there's a lot of debt capital out there. So if you do have a loan maturing, you're an experienced sponsor, you know what you're doing. I mean, you're in a better position to be able to work through that than you would have been last downturn. Any other questions? All right. Well, I think it's 8 o'clock. Just want to thank everybody. Hopefully everybody enjoyed it. Hopefully I thought it was a great discussion. Thank you everybody on the panel for taking the time to come out. Hopefully we'll see everybody December 16th, and for the young professionals, hopefully we'll see you tomorrow night. Thanks again.